SCHD, which is a cornerstone for dividend investors, has recently experienced a significant drop of over 7%. For many investors, this kind of movement might seem like it's an alarming signal at first glance, but savvy investors know that the opportunities often lie in moments like these. Here's why this dip in SCHD could be your golden opportunity to buy. Welcome back to the Financial Freedom Show. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest in my future videos. If you want your name to be at the end of every single video, please be sure to check out the description for my membership and hit the join button. Love to have you here. And without further ado, let's get into today's video. So why did SCHD drop? SCHD, or the Schwab U.S. Dividend Equity ETF, had a recent decline that can be attributed to the Federal Reserve meeting yesterday, where they dropped interest rates by 0.25%. Powell actually hinted that interest rates might slow down in their decline in the next year, so that's kind of why SCHD had a huge drop the past couple days. While these factors might seem like reasons to avoid SCHD, they particularly present a great opportunity for long-term investors to capitalize on this temporary dip. This is a rare discount on high-quality companies. SCHD's portfolio is built around 100 high-quality dividend-paying companies selected for their strong fundamentals and consistent track records. These are businesses with robust cash flows, sustainable dividends, and competitive advantages in their industries. A 7% drop means you're essentially buying these premium companies at a discount. Historically, buying ETFs like SCHD during dips has proven to be a successful strategy for long-term wealth building. There's also a higher dividend yield. As SCHD's price drops, its dividend yield rises. This means that new investors can lock in higher income streams from their investment. For those who are looking to build passive income in their portfolio, this dip offers an excellent opportunity to secure a better yield on cost. With SCHD's focus on dividend growth, the rising yield also sets you up for compounding benefits as the dividends are reinvested and grow over time. Long-term value despite short-term volatility. Market dips are often driven by fear and not fundamentals. SCHD's underlying companies still remain strong, and its strategy for focusing on financially stable dividend-paying businesses hasn't changed. Investors with a long-term perspective understand that short-term price fluctuations are a part of the journey. Over time, SCHD has consistently delivered strong returns, blending capital appreciation with reliable income. This dip is unlikely to derail its strong historical performance. SCHD also has a proven track record. SCHD has a history of outperforming many other dividend ETFs thanks to its low expense ratio, which is just 0.06%, and smart stock selection. Even during challenging market conditions, SCHD has demonstrated resilience and the ability to bounce back. For example, during past market downturns, SCHD's focus on high-quality dividend-paying stocks helped it recover faster than many other ETFs. By buying during a dip, you position yourself to benefit from its financial recovery potential. Diversification and stability in uncertain times. SCHD offers exposure to a diversified portfolio of companies across various sectors, reducing the risk associated with investing in individual stocks. Its disciplined selection criteria ensure that only fundamentally sound businesses make it into the ETF. This diversification, combined with a focus on established dividend growers, makes SCHD an excellent choice for weathering market uncertainty while still earning a steady income. The power of dollar cost averaging is also important. If you're hesitant on committing a huge sum of money at this dip, consider using a dollar cost averaging technique. By investing in SCHD incrementally over time, you can take advantage of the lower prices while still spreading out your risk. As market stabilizes and SCHD rebounds, your average down cost basis will enhance your overall returns. And timing the market versus time in the market. Why time in the market matters? Instead of worrying about catching the market's highs and lows, focus on staying invested. Here's why. Number one, market rebounds are unpredictable. Some of the best market days follow periods of intense volatility. If you're sitting on the sidelines waiting for the perfect time to re-enter, you could miss out on significant gains. For example, missing out on just a handful of the market's best days over a decade can dramatically reduce your returns. Staying invested ensures that you're positioned to benefit when the market recovers. Number two, compounding needs time. The longer you stay invested, the more time your investments have to grow and compound. Dividend reinvestments over time can create a snowball effect, turning small, steady gains into substantial wealth. SCHD, for instance, rewards long-term investors with consistent dividend payouts. By reinvesting those dividends, you can purchase more shares, which in turn generates more dividends. Over years or decades, this compounding effect can lead to exponential growth. Number three is stress-free investing. Trying to time the market creates stress and uncertainty. You're constantly second-guessing your decisions, worrying about whether you bought too high or sold too low. Time in the market allows you to take a more relaxed, long-term view of your investments, focusing on overall growth rather than short-term fluctuations. Why SCHD is a perfect choice for long-term investors? SCHD is a prime example of why time in the market beats timing the market. It has steady income. SCHD's reliable dividends provide consistent returns, regardless of short-term price movements. It has good dividend growth. Its holdings are selected for their ability to grow dividends over time, enhancing your income as you hold your investment. And it has resilience. SCHD's focus on high-quality companies means it tends to recover well after market downturns. By holding SCHD through market cycles, you can benefit from its consistent income and potential for price appreciation. History has shown that trying to time the market often leads to missed opportunities. During these downturns, fear drives many investors to sell, only to watch the market rebound shortly after. Those who stay invested not only recover losses, but also capture the upside. Consider this, even if you had invested at the worst possible time before a major downturn, holding on to your investments would have yielded strong returns over the long term. The market has consistently trended upward over decades, rewarding patient investors. Here's how to stay invested during market volatility. Number one, adopt a dollar cost averaging strategy. By investing a fixed amount at regular intervals, you can take advantage of both high and low prices, reducing volatility. Number two, focus on your goals. Remind yourself why you're investing in the first place. Whether it's retirement, passive income, or long-term wealth building, a short-term dip is unlikely to derail your long-term plans. And number three, tune out the noise. Markets move based on short-term news and sentiment often, but these fluctuations barely reflect the underlying value of your investments. When it comes to building wealth, the secret isn't in perfectly timing the market, it's in staying invested and letting time do the heavy lifting. Dividend ETFs like SCHD are designed for this exact purpose, providing consistent income and growth over the long haul. Instead of stressing over the market's daily ups and downs, focus on the bigger picture. Stay invested, reinvest your dividends, and give your money the time it needs to grow. Because in the end, it's not about timing the market, it's about making time in the market work for you. With SCHD, a 7% dip may seem concerning, but for patient long-term investors, it's a rare opportunity to buy into one of the best dividend-focused ETFs at a discounted price. With its proven track record, high-quality holdings, and a focus on dividend growth, SCHD remains a powerful tool for building wealth and generating income. By acting now, you can take advantage of higher yields, lower costs, and the potential for strong long-term performance. Remember, successful investing is about seeing opportunities where others see challenges. SCHD's dip is not a signal to panic, it's a signal to prepare for future gains. I hope you enjoyed today's video from the Financial Freedom Show. If you did, please be sure to hit the like button and subscribe in order to stay up to date with the latest in future videos. Leave a comment down below if you're adding more SCHD on this dip to your portfolio, and I will see you in the next one. Thanks for watching.